thank you so much for joining the webinar tonight. Appreciate you guys taking the time to come and, spend the evening with us to learn about asset management, multifamily asset management. Me and Dan, this is basically one of the things we do a lot on a day-to-day basis, being full-time, asset managers. This is what we live and breathe every day. It's more or less a 7-day job than a 5-day job. A lot of times, a lot of asset managers like us, this is also our business. And so, with any other business you do, usually, unless you're an employee, most of the time, the work doesn't end at 5. You go at 5, you get an email from manager at 6 p.m., or you get a call from property manager at, midnight. You still gotta take it. You gotta respond over the email, even on weekends. And so asset management is basically what we do on a day-to-day basis. And so we'd like to share with you guys some of our experience, some of the things we do, lesson learned. And, I couldn't think of anybody better to, share this webinar with it than Dan. I've known Dan for a while, so looking forward to sharing about, his experience and my experience. And we're gonna have a Q&A. So the plan is we're going to do we're going to start with just a general introduction to ourselves, and I'm going to introduce myself, and Dan's going to introduce himself, and then we're just going to give a quick overview on what asset management is, and then once we do that, then we're going to go ahead and kind of go to Q&A. Q&A is more or less an interactive webinar where we just want to chat. You ask any question about asset management, we share with you based on what we know. We know we don't know everything, so we're always learning every day, and every day is a reason to improve, and we're looking forward to, sharing to the best of our knowledge of what we know.
Appreciate it, Jack. Great to be here tonight.
Yes. So, so just a little bit about me, Jack Aduo. Been doing real estate investments since 2009. We started with single family in Boise, Idaho in 2009, and fast forward to 2014, we moved to multifamily. 2017, we moved into multifamily investments. That's what we've been doing since then. We 100% focus on multifamily investment, mostly in Texas and Arizona. And of course, we're expanding into other places like Florida and Georgia. I'm the president and CEO of Kendu-Bay Properties. Kendu-Bay Properties, the entire portfolio is about 2,000 units. We have everything from Class C to Class A. When we got started, we used to focus on C class assets, then we move into B class. And right now we focus only on A class assets. And that's because, it's one of those things. You choose your own battle. You choose which area you want to focus on and just be good at it. And we feel like that's the kind of battle we're choosing lately. Our current asset under management is about 250 million, give or take somewhere around there. And we've sold some properties, and we'll be glad to provide a case study on some of those. Just a few things about Kendu-Bay property itself, from just so more a little bit about what we focus on. Our primary focus is basically go identify a property, acquire it, and then raise money through syndication so that investors can invest into that asset and be able to make profit together along with them. So all our properties are basically financed through syndication, whereby you basically have a bank bring 80% of the money, and then us along with our investors put the rest of the 20 to 30%, depending on what kind of asset it is. And as part of that process, we go ahead and asset manage their property so we can do everything from business plan execution, so that at the end of the day, the investors can make profit from that asset. We're very, very strategic on things on markets that we invest in. We're very careful. We don't invest in every market. We invest in markets whereby 3 things must be met. One, the average household income has to be growing, low crime rate, the local employment areas above national. The area does not have rely heavily on one industry, whereby one industry or one company make more than 30% of the population of the local economy. So we're very strategic. And we've been mostly in the Sunbelt market because they tend to be landlord friendly market, which make it easy for us to be able to come in, execute our business plan, increase rent, and reduce expenses, and be able to help our investors make profit. That's kind of super high level about Kendu-Bay properties. At the end of this, we'll provide our contact information. So if anybody wants to learn more about our properties, Kendu-Bay properties or Life Water for Dan, we'll be providing contact information at the end. So if you want to learn more, you can reach out to us directly, and we'll be glad to share more. So Dan, I'll let you introduce yourself and tell more people about yourself.
Okay, I appreciate it. Thanks, Jack, for having me on as a co-host. My name is Daniel Lickman. I'm Director of Acquisitions and now Operations for Lightwater Capital. We are a multifamily company based in New Jersey with close to 3,000 units under management. I joined the company in January of 2021 as Director of Acquisitions. Since then, we did about 150 million in multifamily, and I oversee the portfolio in Atlanta, about 1,300 units. I'm excited to be here, and look forward to any questions or interactions that you may have with us.
Thanks, Dan. So on that note, maybe the first thing we want to just, before we deep dive, we just want to kind of be narrow focus, because sometimes asset management could be, a little bit too, what's the right word? It's too broad. There's all kinds of asset managers out there. And with us, we want to make sure that, we indicate exactly which area we're talking to. So in this case, the asset manager in this case is for multifamily assets. And some of the things that just to kind of provide a textbook term of what's asset management, right? Basically, asset management is the practice of operating multifamily asset on behalf of investors with the goal of increasing value of that property so that investors can make profit from cash flow and the sale of the asset. Basically, you manage the asset on behalf of the investors, right? So that they can make profit. That's basically what it boils down to. Initially, asset manager in this case, usually most deals, you got one or two or three asset managers, usually 1, 2, 3. Asset manager can be an employee of a big company, or for a small company like us, basically, as a general partner, like me in this case, for Kendu-Bay Properties as the primary asset manager. I have people that, are always, assisting me within the Kendu-Bay Properties to help manage the properties, but it always boils down to, me taking the lead on most of the tasks. Let me just admit more people here. Get down. So, asset manager is basically involved on the day-to-day operation of the property, right? By day-to-day operations, they're definitely not the same as property manager. Property manager, is the one involved in, is basically the boots on the ground, the front line, right? They're the one who dealing with the tenants, leasing, marketing the property, doing all the groundwork, from, screening tenants to listening to tenants to, getting vendors to bid on projects to, rent collection, they all everything, right? They're basically there. And asset manager is one level above the property manager. So asset manager is the one that basically oversees the property manager. So property manager or property management company reports to asset manager. And then asset manager in turn report to the investor. So if you're an investor on the deal, usually, the person who you'll be working with is asset manager. Basically, that's the person who is going out to execute, your wishes and what you need in order to generate the profit for you. Asset manager, ultimate goal is to maximize the value of the property so that we can sell it at a high profit for you. while maintaining acceptable risk. There's always risk involved in every decision. Asset manager, basically the one involved in all the key decision of the properties. And you basically be relying on them to be able to make all the decisions based on all the information they have on hand and be able to help, at the end of the day, generate profit for you. They act as fiduciary to their investors, which is very key. So their ultimate responsibility is to you as investors, and so sometimes you'll always see a confusion between asset manager and property manager. Just know that, asset manager is the one that kind of run the property on your behalf, and they in turn hire property manager to be there physically at the property to run the property on a day-to-day basis. So, anything else to add with that, Dan, with regard to asset management?
Yes, I wanted to just add to your point, asset management versus property management. Property management is much more getting into the weeds, boots on the ground, like you said, really involved on a day-to-day operational level with the resident customer service level, the collections, the operations, the improvements of the asset. Versus asset management, although you may be involved on a daily basis, you're checking in either on a daily basis or a weekly basis with the property managers. You're having, let's say, a weekly call to go through certain KPIs to discuss how the property is performing, and it's more of a high level, bigger picture. Some of the KPIs that we always look at, let's say our occupancy, how the collections and delinquency is doing, any work orders, what's pre-lease, move-ins, move-outs. It's more of a high level picture versus the day-to-day dealing with the residents. It's a little bit more removed, but it's still very important to be hands-on and to be at the properties at least once a month or once a quarter or once a week, depending on what the properties need, even from an asset management level, to really focus on those high-level KPIs to make sure the property is performing at its best.
Through that, thank you, thanks, Dan. So, maybe other things we can, now that at least we understand what an asset manager is, right? Basically, in terms of their primary role, asset manager, is very, very involved on a day-to-day basis. Some of the things, for example, they do include, for example, there's always all kind of emails and phone calls going back and forth between asset manager and property manager and investors and lenders and attorneys, and there's always all kinds of people involved in a property. Because think of this is basically a business, right? It's a business in the form of multifamily, and so like any other business, there's all kind of legal stuff you have to deal with, you have to work with, and the act of running the property. You, for example, could be having, say, a 200-unit apartment. That's 200 tenants you have to deal with on a day-to-day basis. Luckily, the property manager is basically kind of, is the gap, is the bridge between you and those tenants. But usually, the property manager in turn has therefore a lot of things that they're going to be relying on you for approval and this and that. For example, with me, I know on some of my not some, but all my properties, we have a mandatory weekly calls with property manager. Is every week we must have a call with the property manager, and on those calls usually involves, we review with the weekly performance of the property. We review rent collection, we review, delinquencies, we review vacancies, marketing and leasing activities. We review ongoing maintenance projects, whatever major CapEx we have going on, review approving it. There's always a vendor that need this or a vendor that need that, vetting on the vendors, bids. For example, we have a requirement that anything that's going to be over $500, will need our approval, right? Any vendor that is, except for recurring stuff. If something recurring, that's fine. Anything over $500 will need approval, and usually if it's more than $1,000, then we would want at least 2-3 bids. So the property manager will go out, look for 2 or 3 bids, bring it to us, we review it, we approve it, we compare and contrast. Exception to apply if it's an emergency. We might not get 3 bids, right? For example, I know in one of my properties we had a pipe burst, plumbing pipe burst, and that was causing some of the units to clog. So we had to act right away. It was a $7,000 repair costs. And, in that case, you don't have time to look for 3 bed. So there'll always be those emergency things that you have to kind of prove right away. But the property manager still have to tell you. So there'll always be those things to deal with. We have, monthly reviews, like the property manager always send you monthly uh, financials that you have to review, along with the weekly, right? Weekly also has the financial in terms of every week they're supposed to say, okay, this is what we collected this week, is all the tenants that are currently on delinquency and their status, like where they all are in terms of like usually those that are being evicted, like usually like with my properties, after day 3, they get 3-day notice. If they don't um, pay, then by the 10th day we file eviction on them. And usually, by the 15th day, for example, when we meet with the property manager, there's like, here's a list of all the tenants and here's the eviction status. For example, the court date is set to this, or the court has been, eviction has been granted and the sheriff is supposed to come, to serve them. So there's always all those kind of stuff that are going on, lender. There's always, with this kind of properties, with the type of loan that we work with, this lender engagement every month, right? We have to provide financial document to the lender every month, and there's always some lenders have question here and there. You could also have some, equity partners would also be involved in the project, and they'll always ask question every month, this and that. They need to be clarified. A lot of lender, for example, require that asset manager, like in our space, also sign the loan, because asset manager is basically the one that's going to be executing on the business plan and getting the property from point A to point B. So the lender want to know that, hey, you need to guarantee the loan. So I know some lenders would have that as a requirement, that anybody who's going to be asset manager must guarantee the loan, just so that, make sure that they're in the hook. And those government related items, for example, tax filing, that's a key part of what we do. Every year, during tax season, there's all kinds of email. I think Kendu-Bay properties, we have over 500 investors, so you can imagine that's over 500K ones that we have to deal with every year. And as you can imagine, there's always somebody's, situation changing in terms of, like, for example, they change their mailing address or whatever it is, and you always have to update those. So there's always a lot of back and forth going on. So you have things that are day-to-day basis, like very engaging. Some are monthly, some are quarterly, some are yearly, but there's all kinds of activities that are going on a day-to-day life of an asset manager. And you definitely need an asset manager who knows and has experience to do all those stuff, because, when you look at it, it might look simple, but before you realize it's a whole day job. Like I indicated to you, I took my family on vacation this last weekend, and even when I was out with the family on vacation, I was still responding to the email and responding to questions both to my partners and some investors and profit related. And so there's always, it's kind of like one of those, cases whereby, you're forever, making sure that you're on top of everything, because at the end of the day, your goal is to make the highest profit for your investors. So you have to be fully engaged, and there's no break. Dan, anything else to add on that?
Yeah, definitely. Just going back to a couple of points regarding the weekly call, the importance of the weekly call is actually to read between the lines. Many times sometimes we'll hear from our property managers that maybe an inspection, whether it's a Section 8 inspection or a standard inspection, is taking a long time, and they're struggling with it. So we'll hear that, and we'll kind of take the initiative to say, hey, let's see if we can reach out to the supervisor. Let's see what we could do to help from an asset management perspective. Maybe the property manager wasn't successful in getting it expedited, and they're going to be a month out for inspection. We may be able to reach out and get somebody there within a week or two. We may be able to help expedite the process. So that's just one example of the importance of the weekly call, and to really take note of action items and things that you can do as an asset manager, maybe behind the scenes. The property managers have 1,000,001 tasks to do, whereas an asset manager is a little more focused, high level. Then maybe they could help with the general picture, the occupancy, say, hey, how could I improve and get those 2, 3, 4 units inspected so I could move people in? Maybe I could reach out and help out. So that's definitely a big factor. In terms of the lender, another thing that an asset manager definitely has to partake is that a lot of loans require to submit a lender draw. which usually the property management company is going to submit, and then the asset manager has to actually go through that and siphon and see if there's anything else that needs to be added, anything that maybe, there are certain units that were already completed or almost completed that we can add to it. That's something that as an asset manager from behind the scenes, a little bit higher level, it's important to kind of fine tune that to make sure you're getting as much funds as possible from the lenders. That's just another aspect that I would add, in terms of the lender reserves and draws, and something that you're in touch with the lender communication.
Yeah, and that itself could be very time consuming, right? Just because with every project, there's all kinds of line items that and the lender, depending what lender you work with, someone wants every single receipt or everything you paid. Some might have some threshold, and so you'll always be lender draw definitely keep part of that engagement. You'll always be involved in. So Dan, curious, what's your thoughts? Uh, from an asset manager point of view, with the idea of reducing cost, for expenses and all that stuff. What would you advise, or tell people in terms of like some of the things you should consider as an asset manager? Because it's not just raising the rent, right? But also reducing the
Yeah.
expenses, or doing
Yeah.
both, right? And what are some of the things
Definitely,
from your experience on how to reduce costs so that there could be more money for the investors?
Sure. So a few things that we do. I mean, I also do the acquisitions and underwriting. So one of the things that we do when we're on the contract is to look at all the utility bills. So we analyze all the utility bills, and if we think that the per unit costs or that the water and sewer bills are higher than they should be, we're going to send it to a company we use based in Ohio called NOI Consultants, or NOI. I'm sorry, blinking out. They're a low flow company. They're based in Ohio. We use them all the time, and we'll send them actually the bill. They'll analyze it. They'll send us a proposal to put in low flow toilets and low flow aerators. So that's something that we do, which we execute when we own the asset as an asset management, and as part of our business plan, is that we switch out all the toilets to be low flow toilets, low flow aerators, and we've seen tremendous success of that, upwards of 40 to 50% savings on utilities. So that's number one. That's a big factor. Another thing we do is we always look at the contracts. Unless we have to assume contracts, we always like to see if maybe their previous contracts or the current contracts that you may have, maybe while you already own the asset, you can go through it. It's important to go through the contracts, and I would say maybe yearly or twice a year to go through them, focus on them, and see maybe there's something that you could tweak. Maybe you could change something when it comes to maybe like a trash contract, for example. Maybe there's too many pickups, or maybe there's something that you need larger bins but less frequency. Being creative and thinking out of the box and not just kind of sticking to what you have may help you save thousands of dollars. Another thing to negotiate is something, cable contracts. A lot of properties don't have an exclusive cable contract, and when you take over the asset, you could sign up for an exclusive cable contract, and that gives you per unit fees, and there's also quarterly income that you could gain from that. So that's another way of improving income. Another thing would be your taxes. Real estate taxes are a big factor. Every state and every market is different as to how they get reassessed. Some of them get reassessed right away. Some states it takes a little longer. It could take a year or two, maybe longer, depending on the cycle. But it's important to underwrite the taxes correctly, and also to have a really the best tax consultant that you could find. So recommend reaching out to all the tax consultants in the market, really building a relationship with them to find the one that you feel is the best one for your goals and your business plan, and really making sure that you get an appeal if you feel that the property was appraised at a higher value than expected. Making sure you're on top of bringing down those costs, because those are something that if you take action as an asset manager, you have the ability to actually bring down those costs, which if you just take inaction and you don't pursue it, your taxes will get reassessed and you'll end up with a much higher amount. And the last thing I want to focus on is insurance. Insurance is a big factor and a big thing that everybody's talking about, whether you speak at conferences or just day-to-day. Insurance is a big factor. There's certain states that insurance is getting to be prohibitive, like Florida, they say, Texas, some parts, Louisiana. It's been very challenging. It's very important to have access to all the markets and have good relationships. Recently, we had a property of ours in Atlanta that was coming up for renewal, and due to some losses and some other issues at the property, our renewal was going to come out to a crazy number. over 2,000 a unit, and that was just an insane number. It just would have really hurt the deal. But thank God, due to actually a conference I was at, an IMN conference in Atlanta about a year and a half ago, where I was chatting with a guy that I knew from here, from New Jersey, that used to work in an office building. He told me he has a special product that he has, access to. I reached out to him as a last ditch effort, just to see, a Hail Mary, so to speak, just to see if there's a way to save money on costs. I wasn't so hopeful, but I said, hey, if you could do something, you got our business. And thank God, 3 days later, he turns around the quote at half the amount, a little over 1,000 a unit, which is still on the higher side, but at least it was manageable and within budgeted for what we had anticipated in year two, versus the other alternatives. So it's always important to have access to different insurance brokers and agents and markets, and make sure you unturn every leaf and every stone, so to speak, so that you can make sure you're getting the best cost, the lowest cost possible for each deal. So that's just a few factors.
Oh yeah, those are definitely great points. It's funny you mentioned that because just I just want to add some examples to that. One of my properties, we had landscape, different quotes from 2,900, from 2,100 to 2,900. That's no, yeah, I think those 2,900 is 2,500, 2,100. And so if you think about it, that difference, I mean, in the same landscape, it's not like, um, they work on different properties. So you can be getting very different bids on vendors in terms of capex or whatever project you're working on, and it was extremely important to vet. I think part of our advantage is that some of the markets we have a strong presence, so it make it easy for us to know. Like you could have one vendor giving one deal on one property, which means you just have to ask them to give you a bid on another property. Like for example, in this case, we had this one vendor that was working on our property, and we told like, hey, we're paying 2,500 here. Can you uh, give us a bid on this? And they came on that property. They provided 2,100 bid for landscape. We don't know them. We have good working relationship with them, and we're able to just save $400 per month. I mean, that's basically almost $5,000 a year. Which translate to a lot of expenses. Insurance is another example. It's funny. One of the property we acquired in Texas, we acquired it from a major. The seller is one of the largest property owner in the entire country, and the insurance they were paying, we ended up saving about $70,000 per year, on insurance compared to what the seller was paying. So,
wow,
having a key insurance broker that can help you find a good deal is simple. Usually in Texas, whereby things are increasing by left and right. Every year the insurance is increasing. As a matter of fact, with us, we're assuming 30% every year. And
wow.
this property, it was a true icing on the cake because when we're underwriting the property, we had underwritten that we're going to pay 30% more than what the seller was paying. But not
That's
only we
unusual,
don't do
Jack.
that, yes.
That's very unusual.
you
Usually,
know,
usually you anticipate,
yes,
maybe 20 or 30%, and it comes out 40 or 50%, and you have to figure out if the deal still works. It's usually not the
yes.
other way around. So that's great.
Yeah, it's funny to put it more, to add more color to it. Um, the seller was basically paying about 300,000 per year, and when we engage our broker, he came with $200,000. And then, of course, the lender always has their insurance consultant who is demanding this and that. So the lender basically had us add more stuff to it to bring it to 230,000. So in other words, at 200,000 probably would have been fine. Would have probably saved $100,000 on that. So we were very lucky in that. The other thing, funny on the same, this is now a different property. We just had a tax appraisal, or no tax protest, that is, and the tax protest we were using basically just had us pay have the property have us pay less tax compared to what the seller was paying 2 years ago. So sometimes, having the right people that can help you negotiate some of those is extremely critical. as part of asset manager, right, you always want to make sure that you go above and beyond in reducing expenses because you know if you can save on property tax, that's more money to the investors. That's what it boils down to. And so I'm glad you had similar experience, and there are truly true ways, proven ways that you can reduce the expenses. You just have to know the right people to talk to, the right people to engage, and yeah. So Dan, let's anyway. I don't want to lose track of time. I want to make sure that we're 36 minutes into the hour. So maybe what else can we do? Do you have anything else to add before we open Q&A? I want to make sure that we
Sure.
respect people's time.
Sure. I'll just add, we spoke about things to save on cost savings. I want to
Yes.
throw in one more story that happened recently, and then I want to talk about things to bring, actually raise other income items
Mm-hmm.
besides, rental increases. We had a scenario recently, about 2 months ago. One of our properties in Atlanta, just overnight, there was a sinkhole that came out. Thank God it wasn't in a place, nobody was parked there. It wasn't in a place that, thank God no injuries.
Mm-hmm.
We made sure to, caution tape it off, and we started getting some bids. Our management company went and got us bids. I think the bids were anywhere from $30,000 to $35,000. I reached out to a local guy, a guy that I know locally that manages, multiple properties in Atlanta. Obviously, that's the
Mm-hmm.
importance of having good contacts of people in your network that have access to vendors. He gave me a guy. I highly recommend him. He's a smaller company. He'll probably give you a better bid. I reached out to this guy. His name was Juan. I said, Juan, could you go out there? He was there 2 days later. He gave me a bid, all in all, for about $7,000. Did the
Oh,
job
wow.
completely. So that's definitely a big factor of maybe taking that extra step. The property managers are busy; they do what they can. They'll put together a couple of bids, and that happens, and it makes sense. They'll reach out to their local vendors, and sometimes an asset manager, you have the ability to go above and beyond a bit more to actually do what you can to bring that cost down as much as possible. So when an unexpected cost arises, instead of being a $30,000 to $35,000 expense, all in all, $7,000 is a lot more manageable to get the job done. That's just one example of, like to your point, of really
Mm-hmm.
making sure you get the best bid possible. Obviously, it's not possible in all situations. If you have an emergency and you need to take care of something, you can only do so much. But in a scenario we have a little bit more time and flexibility, it's important to always, go that extra step to find the right bid. In terms of other income items, so we actually did recently, two of our properties in Indiana had laundry rooms. The previous seller owned the machines for 10 plus years outright. So there's no laundry contract. So you didn't have to deal with any contract. And I noticed that our laundry income on a monthly basis was minimal, was between $700 and $900 for large properties, one of them being a 96 unit, the other one a 300 plus unit property. So I reached out to my regional manager to ask him what's going on. And he said, honestly, Daniel, most of the machines are broken. They don't work. So we're not really capitalizing. People don't really use them. They're old, coin-based machines, top loaders, and they're most, I would say, 56% don't work. So I reached out to a local guy actually here in New Jersey that someone connected me with. And I asked, hey, do you have a good contact for a laundry machine, somebody that either leases them or sells them? And he gave me a contact. So I reached
Mm-hmm.
out to the contact who's based here in New Jersey, who was excellent to deal with. And he got us a proposal. He said, okay, either you can lease the machines at a certain amount, or you could finance the machines and do it as a CapEx item, which is an option if you have that CapEx available.
Mm-hmm.
And the advantage was that instead of it being just a revenue share where you're just taking a certain amount of money based on the usage, you're actually taking the full 100% of revenue above the leasing costs. So we have an expense every month per machine at a certain amount, like $48 or $50, and we put in front loaders, brand new LG machines. They look beautiful. They put them on pedestals. They have an
Nice.
app. You could run them once a week. It's just a game changer for us, where a property that was making $700 to $900 of revenue, we're anticipating making $1,500 to $2,000 above the leasing expense with brand new machines, and that's an amenity to add to our residents as well. And it looks fantastic. So that's just one small thing that if you take over a property that doesn't have a contract, or the contract expired, and you have the option of getting out from the old machines that most of them don't work and are not operable, you could bring in
Mm-hmm.
new machines either as a lease or as a finance, and that's an option of really increasing revenue. Another thing is, This is kind of more basic, is the pet fees, making sure that residents are being charged for pet on their ledger for pet fees or pet deposits. A lot of times, the residents, won't let the property managers know about that they have a dog, and then you'll walk around the property and you'll be like, okay, that guy has 2 dogs, that guy has another dog. So just tacking on those fees as a way to, to add income, because at the end of the day, it's important to have that type of revenue for when they move out, because it's usually going to be damaged. So that's an important factor. I spoke already about cable contracts. Utility income. Another thing is utility income. A lot of times, it's very important as an asset manager to focus on whether or not you're getting the RUBS. RUBS is, reimbursement for utilities, utility billback systems. And there's actually a company also based in Ohio, which I haven't used yet, but I have spoken to numerous times, that will actually take on the billing and reach out to the residents to bill them monthly based on their usage versus a flat fee. And A, you make sure that everybody has a utility bill back, as opposed to only a part of the property. And B, you're making sure that you're retaining and recouping as much as possible. So a lot of times you'll look at your bottom line and say, okay, we only got about 50 or 60% of the total utility costs that we build back, and this company will actually help you get maybe 80 to 90%. So there's ways to improve the other income items significantly, which, besides the cost savings that we spoke about before, can definitely assist in bringing your other income besides rental income, which comes with renovations and renewals, etc. There's ways to improve on the existing income in place, and that's just a few things. But there's numerous ways to improve other income items.
That's a great point, because sometimes people think that it is just rent is the only way to improve. I mean, you can increase the value of the property through other income, right? And like you indicated, pet fee, cable, they just so with us, some of the things we do, for example, when you're acquiring a properties, we have like this 40 line item checklist that we do, exercise that we do. We basically look at, we take the sellers, T12, right? And we see, break line by line in other incomes. What are they getting today in other incomes? And usually we just fine tune it a little bit. Maybe if they are getting, I'll give you an example, right? For example, one of the property required for trash, they were charging $20. With us, we just increased by $5 to make it $25, right? And you go to the next item, maybe pet fee, they're charging, $15, make it $20. Maybe parking, they're charging, $30, make it $35, whatever it is, right? And so we go through this like 40 line item of what they're doing today and where we can improve or leave it as is. But we also tend to focus on exactly what are they not doing today, because that's where excuse me, that's where the biggest chunk of the money is in what they're not doing today. And we try to hone in on that based on our experience in the market. And you'll be surprised, even some very experienced property managers or owners, that is, you'd expect that they would know how to run certain assets, and you'd be surprised about the things that they're missing. But again, our approach as syndicators, we're not there to hold the property for 20 years or 15 years, right? With us, we're there for 5 years. So we're basically going to look at every line item and see where we can improve with the intention, like, hey, 2-3 years later, if all goes well, be able to sell the property and make a good profit for our investors. And so, other income is one area that you'll be surprised, even if you're not able to increase rent, just by increasing other income and maybe reducing expenses, you can still reach the same goal. I like to give the analysis that, hey, 1 plus 1 is 2, but also 4 minus 2 is 2. So it's 10 minus 8 is 2, right? So you can arrive at the same end result using different routes. It doesn't have to be just rent only that you increase rent. I know that's the biggest elephant in the room. But remember one thing, when we're looking at a deal, it's more than just one piece of the puzzle we're doing. But and that's the acquisition side. I want to say that's the acquisition side. But then, once you acquire the property, that's where, as an asset manager, you come handy. Now you execute on those visions. Before you acquire the property, you have a vision what you can take it to, right? Based on what the seller is doing, based on what's going on in the market, based on what can be improved. And post closing is now you, the asset manager, to see how you can now turn those vision into a reality, but basically executing the business plan, right? Start with hiring the right property manager who can be in tune and in line with your goals, who will work with you. I remember we were trying to switch a property management company, and one of the people we interviewed was saying like, hey, asset manager is not allowed to come to the property without the consent of the property manager. I'm like, no, that's a big no-no. And they were like, we don't have weekly calls. We only have a call once a month. I'm like, no, that doesn't work for us. With us, we're in on this for 2 years if all goes well, 3 years if all goes well. And which means we have to be heavily involved in running the asset from day one, being heavily working with the property manager. It's a collaboration, just to clarify. We're not like, having a big stick on top of the property manager telling you to do this and that. It's a collaboration with each other. At Kendu-Bay Properties, one of our philosophies is, treating everybody with integrity and respect, because this is basically like a sport, and everybody has a role to play. And in order for us to win, everybody must be recognized for whatever role they're playing in the game, right? And they must be encouraged and they must be respected. So whether it's an employee at the property or is a vendor, right, coming, or is a tenant, or is investors, everybody's a role to play, and everybody need each other to execute. And so as asset manager, your goal is to basically juggle in all the involved parties to make sure that they all respect it, they all maximize on their performance so that you can be able to execute and be successful in the project. All right, so maybe we can go to Q&A. I know we have about 12 minutes. Let's see if there's questions here. Hold on 1 second. All right, so we got a question. When setting market rents, how do you conduct competitive analysis? To what extent do you do your research, and how do you ensure it's going to lease at that rate? Dan, do you want to start with that, or you may start with it?
Sure. I mean, it's a great question. Being that I'm in the acquisitions role as well, so that's part of my day to day when I'm looking at deals. Is I look at the market rent and try to see that's a big part of it. Of if we put in X amount, how much rent we can anticipate. And the way I do it is I don't rely on CoStar or Apartments.com. I actually look at properties within a 2 to 3 mile radius, similar vintage, similar year built, and I actually call the properties pretending like I'm actually looking to rent an apartment. Hey, how much is your renovated 1 bedroom, 2 bedroom, 3 bedroom? Do you have, are there any extra charges? I want to make sure that the total rent doesn't include any extra utilities or any other charges, because I'm looking at just base rent. And I'll do that at 3 or 4, sometimes more properties, depending how many are in the market, to get a good feel and flavor. Once I have all that data, then when we're going to tour the asset, we'll actually we'll set up tours to tour those comps to actually see them and make sure they're apples to apples. Hey, maybe this property was built at a similar time, but it had a complete renovation and it's like brand new, versus the property we're looking at is 30, 40 years old and, can't compare. Or maybe the property we're looking at doesn't have a swimming pool on the other property has a pool. So we always look at all the amenities as well, and I'll mark that down in my analysis and my data. From an asset management perspective, I believe most people actually will reach out to their property manager and ask them to do a market rent study, where they'll reach out and do something similar. But I always say trust but verify. So take that data and maybe do your own research, call the properties, look into it, make sure that it wasn't a one-time special, make sure that a lot of times daily pricing does affect it, where the pricing one day is not going to be the pricing tomorrow based on availability. So you want to make sure you do get 3 to 4 properties of the actual data from that that time period, to be able to estimate and get an idea of where your market rent should be.
Yeah, thanks, Dan. Totally agree with that. And if I can also just add on top of that, I think you answered really well. So I wouldn't want to add anything else. But that's a great point. And sometimes, so this is also where for example, you try to get a competitive edge of the market, right? Because having a little bit of understanding of the market is very, very helpful. Uh, and instead of you just going to any market, you always want to try to be in a market whereby you have a little bit of competitive edge. So uh, when a broker bring you a deal, usually, yes, you want to assume the rent is going to grow a certain level, but you also want to assume that what if you can't achieve that? Can the numbers still work? Because it's not just, okay, this is the happy part. You just gotta explore the non-happy part. Like say, yes, we can increase rent by 10%, but what if we cannot increase rent by 10%? Can the numbers still work? What else can we do apart from rent? And that's where you have other things like, expense reduction. Some are very easy to do, like, just based on your experience. So, other incomes and other areas to look into. So in other words, even if you're not able to increase rent, can the other things make up for it? And I agree. I think Costa is overrated. It's a good place to start, to give you an idea where it comes. But at the end of the day, I agree with Dan. It's a matter of you physically or one of your partners, or whoever you're working with to acquire that deal, to basically call the property managers, um, uh, and verify, right? Walk those comps. Because, even when you're doing the diligence, part of what you always want to do is you go to walk your comps to see who they are and what are some of the things they're doing. There's a number of websites out there that can give you hints. One of the things you always want to look at, for example, when you're trying to get who your comps is some of those websites will tell you, okay, people that search on your property also cite this as the property, and they also cite this as the property. It kind of give you an idea who they are, who your comps are. Of course, you have to be, very focused on your comps, right? For example, you have to compare one bedroom versus one bedroom, and it has to be similar one bedroom. Like, for example, one bedroom, 500 square foot, one bedroom versus 500 square foot, or plus minus 100 square foot. You don't want to compare a 500 square foot one bedroom with a 1,000 square foot one bedroom, because they're just not the same. Two bedroom versus two bedroom. The vintage, right? Uh, if you have a property that was built in 1979, of course, a property built in 2000 lowest rent or higher rent, than yours. Even though they might be close to you, so you always gotta make your okay, your comps, are they the similar vintage? Do they have similar amenities? And what else can you improve on that? And like Dan indicated, walking your comp is very, very key for you to understand what they're able to do, and what they're doing today that you think you can improve. Because sometimes, when you see what they're doing, maybe that's what the seller is missing. Maybe that's your opportunity. You know, and it's part of could be one of the advantage you get when you're bidding on a property, because other people around you might have not gone to that property, so they might not seen what that property is doing that you can also be doing to generate money.
Jack, another thing I would add is that a
Mhm.
lot of times the property managers, they see a lot of applications where people say, where else they've looked at, or they've spoken to residents that are maybe touring it and telling them their input about other properties. And a lot of times the property managers actually will tell you what their biggest competitors, and they'll tell you, oh, those two properties up the street are our biggest competitors. And then you go and you walk them or tour them, and you realize like, oh, maybe that property is a lot nicer or has more amenities, or maybe there's something small, maybe the units are a little bit nicer, but if I put that money into the unit and do something similar, my property should be a lot nicer. So there's no reason why I can't get at least that much. So the property managers usually do give a lot of input as well, whether you're looking into the deal or actively asked to managing the deal. They'll be able to provide feedback as to market rents, as to which properties are their competition and which ones you should be looking at for guidance.
Oh, absolutely. And as a matter of fact, also even beyond acquisition, right? Closing, the property manager is supposed to be on a regular basis, be doing market analysis to tell you who are the comps, what are they doing, what are some of the concessions that they're offering right now, what are the rents they're getting, so that's how you keep in touch. You keep in touch with what's going on in the market, and uh, part of property managers just to make sure that they're constantly checking what their comps are doing to make sure that they keep up with everything going on in the market. So
And one other thing to
mhm.
Jack, just to point, is that when you're calling a property and you're looking at it from a map or from your desk in your office, it looks like it could look comparable. It's a mile or 2 miles away. Then when you drive it, sometimes you'll go maybe under an overpass and go to the other side of the highway, and the
Oh
whole
yeah.
demographics, the whole neighborhood could shift. It can go from a good area to a tougher area. It could go from one part of town to another part of town. Sometimes the vice versa. Your property's in a little bit of a rougher area, and you go somewhere that's a nice area. So it's also important to drive it and feel it, to be able to see if that comp that you're saying, oh, it's a mile or two away, is getting $200-300 more, but it's in a much better area. You may not be able to achieve that mark on that market rent. So it's also super important to actually physically drive it and see it and get a better feel and flavor for that little pocket where it's the submarket where it's located, to make sure that it's really apples to apples.
Oh yes, yes, that's very true. It's funny. My first property, the same apply with other income, right? My first property in Dallas, there was a freeway divider, right? So when you look at it from a coastal point of view, it was showing lower median household income. But when you look at it from a census tract point of view, because those are literally a freeway, and the census tract where it was like, I think it's like $20,000 more when you look at it from a census
Wow.
tract point of view. So actually, that's another great point when you look into that. And that's another thing Costa would never tell you, right? Is that it will just give you the 1 mile radius where your comp is 1 mile or 3 mile radius. It doesn't factor in the neighborhoods, and 1 mile is very long, and sometimes you could have a property, on just half a mile away in a completely different demographic that could be complete. There's something dividing you and them that unless you physically look into the property location where it is and everything, you'll not know just by looking at the costa. Anyway, so let me go to the next question here. So the next question is, when comparing Class A versus Class C properties, is your approach to maximizing income different between the two property classes? Uh, what's your thoughts? What's your thought, Dan?
So I would say they're very different. In our portfolio, we have one property that's a 2021 vintage, a Class A property. With that one, our capex budget was minimal. We weren't looking to, raise rent significantly or other income significantly based on renovations, but rather based on the fact that it was leased up very fast and at a lower rate, and market rent, dictated a much higher rental amount that you can get. So that was kind of our value add, quote unquote, play. Most Class A newer properties are not going to have as much bang for your buck. You're not going to be able to go and, unless they've been, unless they're original vintage, early 2000s, typically Class A, I would say late, built in the last 5 years, are usually going to have all the bells and whistles typically. So you can put in some small minor upgrades like backsplashes and smart homes and other types of upgrades and many amenity upgrades. You're really not going to get as much rent increase as you would on maybe a Class C, a little bit of an older, more aged, tired type property, which hasn't seen any renovations in 30, 40 plus years. On those, you're typically going to be able to go somewhere where the rents are already at a much lower basis, put in, maybe $10,000 to $15,000 per unit, and see a $300-400 rent bump. That's much more likely and commonplace and maybe more anticipated and expected on a Class C property than maybe a Class A. However, Class C properties are going to have the struggles with collections, with delinquency, evictions. Sometimes there's crime and other issues at a Class C property, whereas a Class A property is typically a lot better off in that sense, where you may not see those major rent bumps. You're going to have a little bit more of a steady type of clientele, where slight improvements should get slight increases.
Oh yeah, that's very true. That's very, very true. Yeah. I'll give you an example. For example, one of my Class A, the month of July, that is, there's only one delinquent tenant, which is like, I think, $2,000. And another property, we had a delinquency of 30,000. It's an older asset, early 80s asset. So indeed, and the funny thing is, the one Class A, the average rent is about 1,800. The Class B, basically B minus, so to speak. The average rent is it's about $900. So indeed, there's room to grow, but you're definitely going to have a lot of those things. And I think, yeah, with Class A, you might not have much room to grow compared to Class C, depending on what the renovation has been done to it. But also keep in mind, some Class A, there could be opportunities, like, for example, the one done, for example, the one that's 2021, but, you could also have a scenario whereby, the seller of a Class A was under pressure, or basically, um, um, usually when a product come online, the seller's focus is bring it to stabilization so they can sell it or refinance or something. So they usually will give a lot of discount, right? And in order to get it to, stabilization. And usually, and this applies to brand new, like, 2022, 2023 build. And, when you buy it, those first round of concession are going to come up for renewal. So the seller could have given, because they're trying to think about it, there is a 200 unit apartment and they're trying to lease it out. They're going to have to give a lot of discount not to lease it out pretty quick. So in other words, a unit that could be costing 1,500, maybe they give it for, 1,300, right? But that means that when it comes up for renewal, now you can charge 1,500 because you're no longer trying to lease 200 units. You maybe just have 10 units a month that you're trying to lease. And so there's always the benefit with that. But you'll always have a big gap between Class A and Class C. Also depend with location, because sometimes, I tell you, some a Class C in the Bay Area is definitely going to charge way more rent than a Class A in Houston, Texas, right? So sometimes, the location makes a difference, in terms of that. But in this case, if it's the same location, say Houston Class A in Houston versus Class C in Houston, yes, there's room to grow, but you'll never be able to catch up, make up for that difference. Yes, and that's why the whole idea of value add comes, right? Which means, Class C, you truly have a true value add, whereby you can make an improvement to the property and instantly see improvement, but also take the risk, right? Which means, what if you do all those value add and don't get whatever you want simply because of the type of demographic you're working with? I know we're on top of the hour here, but let me just ask, just one more question. We want to respect everybody's time. So how do you ensure you have enough funds for property taxes, insurance, capex, and turnover? Do you set money aside for each month, or raise upfront? Did you get it, Dan, or you
So,
may repeat it?
yes, I heard the question. So, every deal is a bit different, but typically we're going to have, depends on the lender. Also, a lot of times the lender expects certain reserves for insurance and interest reserves and taxes, etc. We always work with different, with our insurance brokers and also with the real estate tax consultant to get an idea of where our taxes may end up, to make sure that we're factoring that appropriately. And typically we're going to have the money. We're going to have the money either reserves, have certain reserves and money up front to make sure that we have those funds allocated for any major increases. Typically, though, a property, once it's operating and going through your value add, you go through your value add plan, is usually going to be able to, out of the operating expenses, should be able to afford those expenses. But if for some reason there's a major increase, so there's a need for an escrow, we're typically going to have those funds allocated prior, and it's been part of our capital raise to make sure that we have those funds on hand, in case it's needed.
Makes sense. Yes, expected. I agree. There's always, reserve that the lender is going to require to pay for those. Raising money upfront is extremely important. We do that on all our properties, and that has been actually, with everything going on the market right now, that has really helped us a lot on number of our properties, especially the one whereby the interest rate has gone significantly high. So you always want to save money for rainy day. It's extremely critical that you save money for rainy day, because you never know, once you acquire the property, what issues you're going to run into. A lot of time, the things beyond your control, like when the Fed all of a sudden increased the interest rate. A lot of people, when they were acquiring the property in 2021, they did not know that the Fed was going to increase this much. So having that money for rainy day is extremely, extremely important. You always want to budget for taxes, even though, like in Texas, we know we'll always save money through tax, protest. You just want to see if you're not going to get that tax saving. So just plan for it. Plan that's going to increase. Insurance, you should budget for at least 30%. The time you took cover is going to increase every after that. capex, you got to put money on the side for capex. Whether it's brand new class A or not, you got to put some money, part of your money for the rainy day fund. So yeah. Anyway, so I think 6:06. So we kind of like gone beyond the 1 hour. So Dan, any last words of before we end the webinar? Anything?
I would say a lot of people want to know, is this a good market to invest in? And what I would say is, you always got to start at some point, whether it's as an active investor, a passive investor. You always got to find opportunities in every market. And although in today's market, it may seem to make sense to put money into maybe a CD or a fund or something that's offering 4.5% to 5%. What I would say, to kind of combat that and suggest that you should continue to invest in real estate is that those percentages and high rates that you're seeing right now are going to be short-lived once the Feds do lower their rates, and once things do come back to more stabilization, hopefully in the next 12 to 18 months, you're going to be back at the 2 to 3% CD interest rate. So you're not really going to see too much of that high interest rate, and also you're not going to see any cost savings or tax savings. So I would say definitely to still look at things maybe a bit more cautiously in today's market to make sure you trust and know the operator and the sponsor, such as Jack or myself. Feel free to reach out. But definitely, even in today's market, there's still deals to be had, still opportunities. And if the way we look at it is if we can make deals pencil and make deals work and asset manage them properly in today's market, then once things do come down, we should be in a great position to refinance or sell when things do come back down to more normal interest rates.
Yeah, totally agree. Yeah, like I indicated at the beginning of the call, I think having a strong asset manager who knows, who is fully engaged, who is working, for your investment is extremely important. It's very important that the experience, it's very important that they know the market. And as Dan indicated, I couldn't agree anymore. So Dan is totally correct with that regards. And if you want to learn more about asset management, with us, we're always available, to discuss more about it, more details with you. 1 hour is not enough to go over everything, but at least this tell you some of the things that asset manager do, based on our experience and what you can expect out of asset manager. We'll be glad to discuss any of these follow-up questions with you, or if you want to learn anything else about asset management, we're available. Okay, so this is my contact information, and we'll be sending this along with the information, when we after the webinar is gone. So feel free to schedule a meeting with us, and here's Dan information. Feel free to, let me just minimize this so you can see. Feel free to reach out to Dan and learn more about some of the projects he's been involved with, is involved in. And, if you want to invest in any of his projects, reach out to him so you can start, the relationship and hopefully, do a deal together. I'm super excited, for Dan to join the webinar with me. This is the first time I'm hosting this kind of co-host webinar. And I'm looking forward to doing more like this. We can just, sit down. We don't have to go any particular topic, just share ideas, thoughts. But sometimes, going through a recorded webinar, or a slide deck is not the same as having an interactive discussion and just sharing thoughts and ideas. So anyway, thanks, guys. Thank you so much for coming tonight. I appreciate you joining us. And please feel free to reach out to us. Reach out to Dan, make sure you connect with him, and hopefully, we can work together on a deal in the near future.
All right. Thanks, Jack.
Thank you.
Take care. Have a great night.